Aflac. Did it sound like the Aflac duck? Aflac. It sounded like a drunk sailor. No, it sounded like the Aflac duck. Here we are. We're checking on the Aflac ticker symbol A, F, and the L. If we look at the Aflac, this is a year-to-date quick snapshot of the chart. High of 73.84. And now we're trading basically towards the lows of the year. Aflac has a nice, decent dividend yield of 2.74%. That's $1.68 a year. They had their ex-dividend date last month, but they have a beautiful PE ratio, 9.23, earnings per share, $6.59. So I was looking at them, looking at that old dividend yield theory that I was trying to explain in one of the earlier videos, which basically states that, hey, the historical average of that dividend yield is typically where the stock's value will return to. So if you start to notice that the dividend yield is going higher than the historical dividend yield, then it typically means that the stock is undervalued. So if we look at Aflac over here on the Seeking Alpha Aflac, click on the dividends tab, and you will see that they have the 269 dividend yield, $1.68, 42 cents per quarter. They have a low payout ratio of 30%. Okay, that's nice. But look at this, 40 years of dividend growth. So if we look at their dividend history, it's going to show that they have paid dividends for 40 years. And for every single one of those 40 years, they have raised their dividend payments. So, or grown their payments. So if we look at the quarterly, they just raised it to 42 cents. Last year was 40, 33, 28, 27, 26. So you see all the way down, all the way downtown here to Chinatown. They have paid dividends for 4 decades and raised their dividends during those times. So dividend yield is what we wanted to look at with regard to our theory, which states that if the current dividend yield, so this is where we're at now, dividend yield forward, 2.69%. Last year was, or the last 12 months was 2.59, and then their average is 2.42. So not a huge difference, but it does show that according to dividend yield theory, that the stock is currently underpriced. It is undervalued. And according to the propeller heads, they're saying it's a strong buy. Wall Street says, hey, hold your horses. And then the authors over there or over here at Seeking Alpha say that's a buy. So I was wondering, could we get any action on a put? If we sold a put just 1 week out, okay, March 24th, 7 days away, could we get any action at maybe around 1%? So if we look down here, so at the $59 strike, we would be over 1%. I'm not sure that I like that action there. Maybe be a little bit more conservative down here. 22.9 on the delta, so just under 23. 45 cents on $58. So what is that number? 45 divided by 58. That equals, 7.07. So almost 1%, 77 hundredths. So right there is close enough for me, I think. But I wanted to look 2 weeks out just to see what the difference in the action would be at $58. Or can we just roll it down another buck or two and still get some nice dividend play? So that's 45 cents at $58 strike. Another week out says, at the 58, it says 75 cents. So that's a big number. That is a big number indeed. So we could probably, and again, if we look at Aflac this year, they're now at the lowest they've traded all year. So they could still be a trend and continue down further. I don't know. I mean, our theory or thesis for the year is it's going to be sideways to down. So it could easily drop a lot next week after the Fed decides what they're going to do with interest rates. Or the market could react and say, hey, I kind of like what you just said there, Jay Powell. I don't mind what you've done with the interest rates. So we're going to react positively and it's going to go in the green. Either way, let's take another look. So if we go to the 58 and we collect 70 cents, we're right at about 25. No, we're almost 28 on the delta. So a little higher than I normally would want to be. So what about the 57? That's a nice 21 delta. We got 80% chance of profit. So if we click into that, so it would be a 2-week trade, 14 days out. If we did 5 contracts on that and tried to collect, let's try to collect $75. So if we collect $75 per contract, see if we can fill that. They're going to take $28,500 and put that into collateral for us. But it is a $57 cash secured put. See if there's some action on this number. We may have to lower our credit just a little bit, but we'll give that a second there and see if that fills for us. But we are running out of time on this Friday, and we want to catch. Oh, it just filled. There we go. 375 on 28,500. Now that's a 2-week trade, so theoretically you can do that 26 times a year. $375 divided by 28,500. So we would be at 1.3% in a 2-week period. If, say, we did it 24 times a year, right? Then we would be looking at a 31.5% return on capital. Now that's fantasy land, right? That is based on if these 5 contracts expire under, or I should say over, a 57 strike. So if the stock price that is currently at 61.35 does not make its way down to 57, then we just keep all of the $375 in our pocket, and then that return is what we would base it on if we did that basically every other week for a year, 31%. So that's what we got on the Aflac. Thanks for tuning in. Do all the things like subscribe, like, comment, share the channel with a lovable friend, and I'll see you in the next video.